Good evening, everyone. Good evening, dear students. How are you all? Are we all good? Yep. You're not able to chat, or I think you should be now. Good evening, dear students. How are you all? Good evening. Good evening. Yes. So now you can talk to me directly. How are you all? All good? Everyone? All are fine? Okay. So happy Dashera to all. So we are in the chapter of financing decisions, capital structure. So I think we have already covered the capital structure part. Initial phase was regarding understanding how to select a typical capital structure with an objective of shareholders' wealth maximization, right? And then we are obviously in the process of also looking for the break-even point, something called as indifference point. I have tried my level best to make you visualize them. And then we also have went ahead with capital structure theories. The capital structure theory was basically if two firms are there and they are exactly on the same line. I mean, if the two firms are having the same set of business, only the difference between them is, let's say, the capital structure. So if the difference is only capital structure, then will the value of the two companies be different, or is it going to remain same? That was something that we were looking for. And then we went ahead that before we discuss on the debate, let's look at some basic formulae for valuation of the business entities. So value of the firm was EBIT upon KO, value of equity is PAT upon KE, value of debt is interest upon KD, and the value of the firm is value of equity plus value of debt. Right? So this was what we have already discussed. Now it's time for us to take up the theories. In a sense that we have already discussed that there is going to be a two set of theories. One set of theories called as the theories of relevance, in which they are stating that capital structure is going to affect the value of the business. Okay. Theories of relevance are basically the theories which state capital structure is going to affect the value of the business. And we have the other theories where we say that those are the theories of irrelevance, where the capital structure is not going to affect the value of the company or value of the business, right? And we already have looked into what do we mean by value. And one by one, we are going to discuss each of these theories in today's class. I think today's class is the last class that we have in the series of capital structure. So let us discuss this in our today's class, and then we will, take up few questions in relation to this, and then complete this chapter. Okay. Let's get started with the first one, which is net income approach. Net income approach. Was it a theory of relevance or theory of irrelevance? Net income approach. It was a theory of relevance. So what this theory is actually trying to portray? It's trying to portray that value of a company will get affected by its capital structure. Value of a company is going to get affected by its capital structure. So what are this net income approach? What is this net income approach say? How does it conclude? What is the justification for their point of view? That is what we are going to look over here. So first point which they state is cost of debt and the cost of equity. Which one of these two do you think is less? Is the cost of debt less than cost of equity, or cost of equity lesser than cost of debt. What's the relation? Cost of debt and cost of equity. What's the relation between cost of debt and cost of equity? Can I say cost of debt is less than cost of equity, right? Because cost of debt is what? It's the rate at which you're going to raise the money through debt. So of course, in that case, the rate is definitely less than the rate which our equity shareholders will be expecting. So cost of debt is definitely lesser than the rate which our equity shareholders are expecting. So we say that cost of debt is less than cost of equity. Okay, that's the first point which we obviously agree, all of us, and that's what the net income approach also says. Now, based on this, they further state that as weightage of debt increases, as the weightage of debt increases, overall cost of debt decreases. So as the weightage of debt is going to increase, overall cost of debt is going to decrease. That is what they're stating. Let me just demonstrate it with you. So suppose a business has got some amount of equity and some amount of debt. Okay. So let's say a business has got some amount of equity and some amount of debt. So initially, the company was having, let's say, full amount of equity as its capital employed, which is 10,000, and there was no debt. So, of course, can you tell me what will be the weightage of equity and what will be the weightage of debt? If the company is having companies financed fully by way of equity, what is the weightage of equity and what is the weightage of debt? Weightage of equity. Can I say 1? And weightage of debt is simply 1 minus this weightage of equity. Right? Now, suppose I tell you that we have got some cost of equity and of course cost of debt. Cost of equity is, let's say, 15% and cost of debt is, let's say, 10%. Right? So what will be the overall cost of capital? How do you compute the overall cost of capital, KO? How do you compute the overall cost of capital? Overall cost of capital is weight of equity into cost of equity plus, can I say, weight of debt into cost of debt. Correct? So overall cost of capital is 15%. Right, guys? Now let's say company states that let us increase the weightage of debt. Suppose the company says that let us increase the weightage of debt. So probably the company will buy back some of its equity shares. So let's say company buys back 1,000 of equity shares and replaces it with debt. So basically, company is taking a loan of 1,000 and repaying the money to the the equity shareholders. Now, what will be the weightage of equity and weightage of debt? What will be the weightage of debt and equity? Can I say it will be now 9,000, of course, divided by 10,000, which is 0.9, and weightage of debt will be 0.1. And then, of course, the cost of equity and cost of debt remaining same. Can you give me what is the overall cost of capital over here? Or let me just take some more terms. Let's say 8,000. Then we have 6,000. Let's say 4,000. 3,000. 1,000. So if these are the equities, right? And let's say the debt. Debt will be like 10,000 minus this. These are the debt values. Can you tell me for each one of them, what is the overall cost of capital? Tell me, what's the overall cost of capital for each of these scenarios? First case, it is 14.5%. What about that in the next case? It's 14%, then it's 13%, then it's 12%, then it's 11.5%, then it's 10.5%. So any pattern do you see? Look at the weightage of debt and the overall cost of capital. Do you see any typical pattern? Do you see any typical pattern, guys? Is it as per the statement they are saying here? As the weightage of debt increases, the overall cost of capital is reducing. Please verify, guys. Are we getting these all numbers? Just check it. Half a minute time to you. Just check. Right? How do you calculate KO? It's weightage. Weight of equity into cost of equity plus weight of debt into cost of debt. Is it clear, Asak? Yeah. So can I say as the weightage of debt increases, the overall cost of capital is reducing. So this first point is definitely very much valid. So as weightage of debt increases, KO is decreasing. That is very much valid. Then point number 3, right? Point number 3, we can say as KO reduces, value of firm increases. Okay. So we have a range of KOs available here. Just to demonstrate you, we have a range of KO or overall cost of capital available over here. Now, how do we get the value of the firm? So let's say EBIT. Now tell me, if the capital structure is changing, is the EBIT of the firm going to change? If the capital structure is changing, will the EBIT of the firm change? If company takes a loan, will the EBIT of the company change? Yeah.
सर चेंज नहीं होगा, लेकिन सर चैट डिसेबल कर दिया किसी ने. थैंक यू सर. थैंक यू सर.
Okay. Yeah. So EBIT, is it going to change? It will not change, right? Because of change in capital structure. Why the hell your EBIT is going to change, right? So let us say EBIT is 2000. So EBIT is remaining same. What do you feel about the value of the firm? How do you compute value of the firm? Value of the firm will be EBIT upon KO. This is the formula that we already covered, right? Value of the firm will be EBIT upon KO. Correct? Okay. So value of the firm will be EBIT divided by KO, which is arrived at in this pattern. Now, what do you see in this case? Can I say the value of the firm is it has been increasing. So value of the firm is increasing from when the KO is 15%, value of the firm is increasing from 13,333 till 19,048. So what we observe is as the KO is increasing, as the KO is as the KO is reducing, we find the value of the firm is increasing. Okay, so can we say that initially when the company was having fully equity, that time we observed that the value of the firm was 13,330, and as we reduced the value of equity and we started replacing equity with debt, we found that the value of firm is keeping on increasing. Correct? Right, guys? Yeah. So value of the firm is increasing with a change in debt. So my question is, change in debt is, can I say, leading to change in value of firm, or I can say change in debt, or you can say change in the capital structure is leading to change in the value of the firm. So value of the firm is changing due to a change in the debt rise or change in the capital structure. So can I say capital structure is having an impact on the value of the firm? Capital structure is having an impact on the value of the firm. So that's where we say value of the firm is, getting affected by the capital structure. Therefore, we say that this net income approach is a theory of relevance because they state that as the weightage of equity falls and as the weightage of debt increases, value of the firm is going to increase. Okay, so that's the first point or first theory that we had to discuss, which is the net income approach. Now, over here, there is some shortcoming in this model, guys, because this model which was presented, way back long time ago, this model which was presented way back long time ago, it was definitely a well accepted norm, but then there was some shortcoming in this model. Can you identify that shortcoming in the model? There's some shortcoming or something is lacking in this model. Some problem is there. Leverage is high, that's okay, but then the model itself is based on certain assumption, and that assumption is not a valid assumption. If you look at EBIT will remain constant. That is not an assumption. That's a very factual thing, that your cost of capital, overall cost of capital is not going to impact your EBIT, because EBIT is depending on your business, right? So just by a change in capital structure, it's not going to impact your EBIT. That's not an assumption. That's a very much factual thing. But there is an assumption underlying in this model. I just want to see if anyone can identify that assumption. Preferences, leave it. That is not something which we cannot consider here. Yeah. Equity shares decrease. Obviously, I'm going to get more debt, so equity shares is going to decrease. AD is constant. Cost of debt will remain constant. The rate of interest is anyway constant. Based on weights, no. Think from the point of view of equity shareholders. Do you think you as an equity shareholder will be expecting 15% return from the company when you were having 100% weightage? And as your weightage is reducing and the company is taking more and more debt, isn't your risk getting affected? Isn't your risk getting affected? Can I say, with an increase in weightage of debt, with an increase in weightage of debt, can I say more and more weights taken by the company will lead to ultimate effect of what? More and more weights leading from the company is going to have an effect of what? It's obviously a high risk for the equity shareholders, right? Because if the company is not able to generate returns and it goes bankrupt, the equity shareholders will lose their money, right? So there is a financing risk which is getting absorbed into the business due to high level of debt. And at higher level of debt, at higher weightage of debt, do you expect the equity shareholders to be requiring same 15% return? Do you expect the equity shareholders to be requiring same plus equity return? No, because that's the basic fundamental problem, we can say, right? So it should be less. So the cost of overall cost of capital, when we're computing, we cannot assume the cost of equity to be remaining constant, and therefore we proceed with the next model, which is an improvement over this, right? Which is an improvement over this, which is called as the net operating income approach. Net operating income approach. Now here we are going to come up with that. We are going to leave that assumption, right? So we are going to leave that assumption here that where what we observed over here, the impact on cost of equity or with the weightage of debt. What is the impact on cost of equity? You can see if I just draw a chart, maybe we get it somewhat like this. Look at this. What we observe is your KE is constant, your KD is constant, and overall cost of capital is reducing. How can we assume that your cost of equity is a constant term irrespective of the amount of debt that you take? Right? That's a problem with the CAM, right? So if you're giving more risk, if you're assigning more risk to the equity shareholders, of course, equity shares would be requiring a higher rate of return. So essentially, their cost of equity should be rising, right? And that's an improvement over here in this model, which is called as a net operating income approach. In this, we say that cost of debt is less than cost of equity. Of course, it's a very much valid point. Further, they say as weightage of debt increases, can I say overall cost KO decreases. So as weightage of debt, as the weightage of debt increases, overall cost of capital decreases. Now the point is, as the weightage of debt is increasing, as the weightage of debt is increasing, there will be a side effect of it also. As the weightage of debt increases, there will be another side effect because of this. Now, what will be that side effect? As the weightage of debt increases, KO decreases. That is agreed. But what is the side effect? The side effect is as weightage of debt increases, can I say KE starts rising? KE starts rising due to higher risk for equity shareholders, right? And as the KE starts rising, what will be the impact on KO? KO will, can I say KO will also increase? Right? Am I right, guys? Yes or no? As the weightage increases, we say that overall cost of capital decreases. But as the weightage increases, there is another side effect. And that side effect is your cost of equity. Equity shareholders start demanding more. And that will be leading to KO being increasing. Now, can I say on the overall cost of capital, there is a dual pressure now. Am I right, guys? On the overall cost of capital, there is a dual pressure. Due to higher weightage of debt, it is being dragged down. And due to greater required return of KE, it is getting dragged up. So that KO line, which was, what we observed it to be falling under an assumption that this particular line is going to remain constant. Now, is it going to remain constant? No. This line is going to take a upward side, right? So let me just take this chart again over there, which is same table over there. So we have observed that KO is remaining constant over here, right? So if I just draw a chart for us, we definitely stated that this line, this particular chart was representing where the green line was falling, because we assume that cost of equity is constant. But is the cost of equity going to remain constant, guys? No, cost of equity will keep on rising, right? Cost of equity will keep on rising. And they say that both these factors, KO increasing and decreasing, will have a combined impact, and your KO will remain constant. So let's say I eliminate this portion and I just take this Yeah. So your KO is going to remain constant. So as a case, this is going to be like 14.5%. So we need to look at what will be the impact on cost of equity. Of course, cost of equity needs to rise. Now, cost of equity will be, I'll just write down this as 40% minus 1 second. Let me just properly put the numbers. So we have like, this is going to be basically the reverse calculation, because we have to ensure, as per the model, they're saying overall cost of capital will remain constant. So this set of numbers, 1 second, let me just take it as 15%. And just give me a moment. Your cost of equity will be, overall cost of capital. This is going to remain same, where they say that it will be 15.5%. So it's going to be 14.5%, and the cost of equity will be, cost of equity will be 14.5% minus cost of debt multiplied with weightage of debt, and then this whole thing is divided by, let's say, weightage of equity. Yeah, this should give us like, okay. So we observe that here it is cost of equity should be rising to ensure that the overall cost of capital is remaining constant. So you can see this is like, now once I implement this number, you can observe that this is really problematic one. Okay. So these are basically the cost of equity. So what this model says is your overall constant cost of capital is going to remain constant because KE is rising. Okay, so cost of equity is, what we observe, it is rising due to greater risk by the higher amount of debt. Okay, Shinish is asking, can you explain in which scenarios NOI approach implemented? It's not something which is getting implemented. It's a theory. It's a theory which is getting debated. So it's not something which is a policy that you are going to implement. Okay, so I'm not implementing any rule or any policy. It's a theoretical aspect. It's a discussion that is being undertaken. That what is whether something is impacting the value of the firm. Okay, so here we get the cost of equity numbers. Now, what we say here is that as the weightage of debt increases, the perceived risk of equity shareholders is rising. So, if perceived risk of shareholders is rising, instead of keeping that as a very much a constant term, like in the previous case, we have taken it to be a constant number. If you take the cost of equity to be a constant, our chart is like this, right? But now, if the net operating income, is applicable, then we can say, sir, cost of equity cannot be a constant term. It needs to be rising. So when you implement it, now the chart changes a bit, and your equity shareholders will be obviously demanding a higher rate of return. Now, of course, without any further saying, we can simply say that since KO is, constant, what should be happening to the value of the firm? If the KO is constant, what will be happening to the value of the firm? Can I say value of the firm will remain constant? Since KO is constant, value of the firm is also going to remain constant. So can I say this net operating income approach simply says that capital structure does not have any impact on value of the firm. Capital structure does not have any impact on the value of the firm, and therefore this was said to be a theory of irrelevance. Therefore, this was said to be a theory of irrelevance, guys. Okay? Is the theory clear? Everyone? Yeah, so it was an improvement over net income approach, where net income approach you assume the K to be constant, right? Whereas here the K is said to be keeping rising. Now, obviously, the underlying assumption over here is K is going to rise so much that the overall cost of capital remains same. Okay.
Sir, sir, can we say that value of equity, if decrease, the value of firm will increase in first one?
No, nothing like that. No.
Sir, in first approach.
And be it whatever approach, it doesn't mean that your value of equity. This is not value of equity or debt. This is the book total capital employed in the business. And when we are talking of the value of the firm, this is the market value.
Okay, sir.
Like in the first case, company is having 10,000 amount of equity invested, but the market value of the firm is 13,000.
13.
Right?
Yes,
so
sir.
we're talking of the impact on the market value.
Okay, sir. Thank you, sir.
Yeah. How do you find K here? Don't worry, because these were the numbers which I computed over here. So that we will learn in the practical problem, but simply by doing the balancing form, because here we say that it is 14.5%, because we say that value of the firm should be constant. So 14.5% into weight of equity into cost of equity. So it is like 0.8 into cost of equity plus 0.2 into 10%. So you just need to typically solve this to get the cost of equity as a balancing figure. Okay, so we'll be doing that in practical problems. We are just discussing the theory and the concept over here. Okay, now in this model also, guys, there is one shortcoming. Can you think what it is? Can you think what it is? There is some shortcoming over here. Or again, I can say this model is assuming something not acceptable in real life scenario. Can you tell me? Yes, cost of debt is constant. Do you think whether you take 10% debt or 90% debt, your overall cost of capital is going to remain same? Sorry, your cost of debt is going to remain same? Do you think that if you borrow for 1,000 rupees, or you borrow for 1 crore, or you borrow for 100 crores, bank will give you money at the same rate? Is the bank going to give you money at the same rate? No. So up to certain point, bank will be like, bank will have a threshold that, okay, this much amount we can give you at a particular rate. Beyond that, we will also charge you higher rate of interest. And that's where we have our third model called as traditional model. Right? So in this traditional model, what this simply says, there will be three phases of gearing. Three phases of gearing. In the first phase, cost of equity will be constant. In the first phase, cost of equity will be constant. So in the first phase, we'll find that cost of equity is remaining constant. Why is the cost of equity really remaining constant? Because they assume that equity shareholders are not going to ask for a higher rate of return for some smaller amount of debt. So it is like as equity shareholders will not ask for higher rate of return for smaller amount of debt. Like they understand, maybe company, if it's a company which is having, let's say, 1,000 crore of equity, and if, let's say, company borrows 1 crore, will the equity shareholders start jumping and they say, we want higher return, we want higher return? Is that going to happen? Is that going to happen? Yeah, tell me. No, because it's like the company is already having 1,000 crores of funds. Due to some short-term requirement, company, let's say, borrows a smaller amount. 1 second, please. Yeah, so cost of equity will be constant as the equity shareholders will not ask for a higher rate of return for smaller amount of debt. So here your KE is constant, your KD is constant, right? And obviously, what will be the impact of KO? If your KE is constant, your KD is constant, what will happen to KO? You're like, if your KE is constant, your KD is constant, KO will fall marginally due to small amount of debt. In net income approach, we already saw this, right? As your KE, cost of equity, cost of debt is constant, your overall cost of capital is falling. So there will be some slight fall that you will observe in the KO. Then we reach the phase 2. Then we reach the second phase. Now in second phase, KE will start rising as equity shareholders now perceive, KE will start rising as equity shareholders now perceive the higher debt as higher level of risk. So KE will start rising as equity shareholders now perceive higher debt as higher level of risk. So what is going to happen? KE rises, KD is constant. What about KO? KO will, what will happen to KO? If your K is rising, your KD is constant, what will happen to KO? KO will remain constant. Right? So KO will remain constant because it is, can I say, the first phase is similar to net income approach. Second phase is similar to net operating income approach. Then comes a third phase. Now in the third phase, bankers also start asking for higher rate of interest. So bankers also start asking for higher rate of interest, right? So bankers are going to start for higher rate of interest as bankers also start asking for higher rate of interest as risk for them also rises, right? So what is happening? K is anyways rising. KD also rises. So tell me, what will happen to KO? If your K is rising, your KD is also rising. What will happen to KO? Both KD and K is rising. What will happen to KO? KO will also increase. Right? KO is also increase. So let me just demonstrate this to you. Let's say weightage of debt, weightage of equity, cost of equity, and cost of debt. So initially weightage of equity and weightage of debt. So weightage of equity is, let's say, 1. So this is like 1 minus this. Cost of equity is, let's say, 15%, and cost of debt is, let's say, 10%. So overall cost of capital, when we compute, it will be, of course, weightage of equity into cost of equity plus weightage of debt into cost of debt. Right? So this is 15%. Now, weightage of equity, weightage of debt, cost of equity, cost of debt, we have taken it for the initial phase. Now, let's say company takes some small amount of debt. Yeah, so maybe it just takes 1% of the total capital as debt. Do you see the impact on, are we expecting an impact on cost of equity? Are we expecting an impact on cost of equity? No, it will remain constant. Right, so let's take it as constant. Cost of debt also remaining constant. So now the overall cost of capital has reduced marginally. Now let's say you take 0.95, and this is like 5% of your total capital. We say that it is still constant, and what we get as the overall cost of capital is 14.75%. Right? So up to certain extent, maybe let's say up to 10% of the up to 10% of the total capital. Let's say you take that, your overall cost of capital is keeping on reducing because cost of equity is remaining same. Now this particular portion, maybe up to 10%, is something which is the phase 1 that we say. Right, so this is the phase 1 where we observe that this is rising. I don't know, there is something. Anyways, so this is our first phase that we were discussing, that this is the phase where everything is overall cost of capital is reducing because the cost of equity is not getting affected. Beyond 10%, then we go to the next phase where we start getting a bit worrisome, where we become the phase 2. Now let's say you are taking greater amount of debt, maybe 0.8, then you have 0.7, 0.6, and maybe up to 0.4. We get the weightages, and based on these weightages, we can obviously compute the overall cost of capital. So now from here, the cost of debt is remaining constant. Your overall cost of capital will remain constant, and what will happen to the KE? KE is, of course, going to get increased, right? KE will keep on increasing. So now we observe that cost of equity is 15.63, and of course now that's just keeping on rising. That's constantly rising because your K starts rising, so your KO is remaining constant. But after a point of time, as we enter the next phase, which is going to be a little bit of scary phase, because there we will observe that phase 3 gets started, and here phase 3 is essentially, phase 3 is basically the risky phase, where if you start getting more and more debt, what is going to happen with the overall cost of capital? Of course, cost of equity is rising. What will happen to cost of debt? So cost of debt will also start rising. So maybe at this phase, you will have 10.5% being the cost of debt, maybe 11%, right? Then maybe going ahead, you will find this as 11.5, and then here maybe 12%. And of course, the 21.25 cost of capital will also keep on rising. So here you will find maybe 25%, even more greater amount of risk. So that will be like 30%, maybe over here 40, and maybe in this case we require a 60% return because of the greater risk that a company has got. Now, of course, the weighted average cost of capital will also change over here. Right. So weighted average cost of capital is also keeping on rising. So let's say this is 35. This is 45. This is also rising. Maybe even a higher rate of return, or really very high rate of return is required, because just a company where 5% is equity, rest all is debt, that's a very risky scenario. And that's where we see that the pattern of capital structure numbers will be essentially working out somewhat like this. So it's a typical structure where the cost of equity is rising. Your overall cost of capital, or if you just look at this range, the cost of debt is also rising a bit. And up to a point of time, the overall cost of capital, if you observe it carefully, if I just shade it with graphs, you observe that the overall cost of capital is lowest in the second phase, and it is higher in the first as well as in the last phase, right? So which is the best phase then? The best phase is basically the phase 2 phase, where you get the overall cost of capital to be lowest. As the overall cost of capital is lowest, there at that phase, the value of the company is going to be the highest number. Okay. Yes. Srini?
Hello, sir. Good
Yes.
evening.
Good evening.
Sir, up to phase 2, risk is same. So then why the K is increasing? That too, in a more frequently it's got increased.
No. K will start increasing in phase 2.
Yeah, but the risk is same now. But there is no increase in risk, or the cost of capital is same, right? Then why is it risk is that K is increasing?
Where is the cost of capital same? The cost of equity is rising.
But KO is same now.
KO will remain constant because KO was falling earlier. Now, due to rise in KE, the KO becomes constant. Just like in the previous net operating income.
Yeah. Okay, fine.
Yeah. Yes.
Yes, sir. I have a same question in phase 2. The K is
Phase 2 is
increased.
same. Phase 2 is same as the net operating income. Because in the net operating income, we observe that your KO, overall cost of capital, was remaining constant because of dual effect. One, due to greater weightage of debt, it was getting reduced, but there was an upward pull due to higher cost of equity.
Okay, sir. In phase 1, K and KD is constant.
Yes, because that's a small amount of debt which the company takes.
KO is decreased, and phase 2 in K is increase, KD is constant, and KO is also constant.
Yes.
And phase 3?
Everything is rising.
Yes, sir. Okay. Clear.
Okay. Sure. Great. Now, we have done these 3 models. Now, apart from this, we have got some other models also, which is the Modigliani-Miller model with the taxes approach and the arbitrage approach. Like we have covered net income approach, net operating income approach, and we have covered the traditional. So now we have to look for this Modigliani-Miller model with the taxes and Modigliani-Miller arbitrage approach. Let me just first discuss the net operating income, not net operating income approach with taxes, which is also called as MM with taxes approach. Okay. Now, MM with taxes approach in net operating income, what did we essentially discover in the net operating income approach? We discovered that the value of both firms is going to remain constant because the KO is going to remain constant. So as the KO is remaining constant, we said that the value of the firm is also going to remain constant, right? So net operating income approach is something which stated that it's a theory of irrelevance. So it stated that in the absence of tax, value of levered firm, can I say, will be same as value of unlevered firm, guys. So in the absence of taxes, value of levered firm will be same as value of unlevered firm, right? This is what we have stated, because even if the company has a debt or the company doesn't have a debt, the value is going to remain same because because your KO is going to remain constant. This is what we discovered, right, guys, in the net operating income approach. Correct? This is what we observed. This is what we have discovered, right? Now, that was under an assumption that there is no capital, or I can say there is no tax applicable in such situation. Okay, so when you don't have any such tax applicability, that's where we observe that the value of both the levered and unlevered firm is remaining same. Okay, so now value of levered and unlevered was same when there was no taxes. But when we have taxes, there is something additional, there is some change which is happening. Due to taxation, there is some change which is happening. Now, levered or unlevered, which of the companies pay interest? What's levered and unlevered? Levered is a company which has taken a debt. Unlevered is a company which has not taken any debt. Okay. So, when we say levered firm and an unlevered firm, so we have like the levered firm and the unlevered firm. Tell me, between the levered and unlevered firm, which of these companies will be paying interest? Which of these companies will pay interest? Yeah, of course, the levered firm, because it has got the interest or it has got the debt. So yes, no. Now, which of these two firms will have tax savings due to interest? Which of these two firms will have tax savings due to interest? Right, so we'll have tax savings due to interest. So due to tax saving due to interest will be, of course, will be there for the levered firm, and unlevered firm will have no tax saving. So for example, interest is, let's say 1,000 rupees. For unlevered, it's going to be 0. What will be tax savings due to interest? Or what will be tax saving if tax rate is, let's say, 30%? What will be the tax saving for the levered firm at the rate of 30%? What will be the tax saving due to the levered firm? If the tax rate is 30%, what will be the amount of tax that will be saved by the levered firm? Can I say 300, and over here there is 0, right? So can I say levered firm will have incremental cash flow of rupees 300. Levered firm will have incremental cash flow of rupees 300. So can I say the levered firm is going to have an incremental cash flow of 300 as compared to unlevered firm? As compared to an unlevered firm, the levered firm is going to have a extra cash flow of 300. Right, guys? So because tax saving is possible only in case of a levered firm, and because there is a tax applicable. This 300 tax saving, is it going to be for 1 year, 2 year, 3 year, or till perpetuity? This tax saving of 300, is it going to be for 1 year, 2 year, 3 year, or till perpetuity? Till perpetuity, right? So levered firm will have incremental cash flow of 300 as compared to the unlevered firm till perpetuity. So till perpetuity, your firms are, this cash flow is going to be there for us. So due to this extra cash flow, don't you think levered firm will have some additional value for itself? Due to this extra cash flow, can I say the levered firm is going to have some amount of extra value? Yes or no, guys? Correct? Unlevered firm means a firm which doesn't have debt. And levered firm means the firm which is having debt. Right? So due to this tax saving, there is an incremental cash flow which is going to be there for the levered firm. Right? So for example, let me take the EBIT. EBIT is, suppose, 10,000. In both cases, EBIT is 10,000. Right? Now, from that, let's say you're paying interest. So interest is 1,000. Over here, interest is 0. So we get the profit before tax. Now, profit before tax is 9,000, and here it is same 10,000. Now we need to pay tax. So let's say tax, it is PBT multiplied by 30%. Okay, so tax is, let's say, 30%, and then we get the profit after tax. So profit after tax will be 9,000 minus 2,700. So it is 7,000, right? We are paying like an extra tax of 300 over here, and this is the PAT. If I ask you what is the cash flow for the firm, cash flow for the firm will be, of course, this 6,300, right? So it will be, of course, the final profit that we have. That's the profit. That's the number which we have, and also plus you will add the interest of 1,000, because for the firm, for the entire firm, after payment of tax, right? Because after payment of tax, the firm is having a cash flow of 7,300, which it is going to distribute amongst the fund providers. So out of 7,300, you will give 1,000 to your debenture holders and you will give 6,300 to your equity shareholders. What is the cash flow for the firm in the second case? What is the cash flow for the firm in the second case? Can I say 7,000 only? Right? This is the net after tax cash flow. Or I can say cash flow for the firm can be stated as after tax cash flow for the firm. So if you look at after tax cash flow for the firm, it is 7,300 and 7,000. So which firm is having a higher amount of cash flow? Is it the levered or is it the unlevered? Which firm is having a higher amount of cash flow for distribution? Can I say levered firm? So that's what I stated here, that there is an incremental cash flow of 300 as compared to the levered firm. As compared to the levered firm, as compared to the unlevered firm, the levered firm is having 300 rupees of extra cash flow. Right? So incremental cash flow for levered firm, can I say it is 300 till perpetuity? Incremental cash flow is 300 till perpetuity. So if our incremental cash flow is 300, incremental cash flow is amounting to 300 till perpetuity, right? Then in such situation, what is the additional value of levered firm? What is the additional value of the levered firm? Can I say this 300 till perpetuity is due to the tax saving, due to the interest? So I'm going to take a present value of 300 till perpetuity. Right. So additional value of the levered firm will be simply present value of 300 till you reach the perpetuity. Okay. Now, how do we work around this additional value? I mean, how do we get the present value of it? This will be simply, 300 divided by, 1 plus cost of debt plus second year 300 divided by 1 plus cost of debt square plus 300 divided by 1 plus cost of debt cube, and this just goes on till perpetuity. And we know the present value will be simply 300 divided by KD. Right? So this is 300 divided by KD. Right? Because if it is still perpetuity, while calculating the value of the firms, you have already seen those formulae, right? Till perpetuity, like the value of the firm was EBIT upon KO, value of debt was interest upon KD. Same way, this 300 is simply going to be divided by KD. Now I can just expand it a bit. 300 is something you got it as. How did we get this 300? This 300 was simply the value of debt, multiplied by, right? So simply it's the value of debt multiplied by, can I say this particular number is, interest divided by KD. So 300 was actually in, 1000 multiplied by 30%, and of course this divided by KD. Now this 1000 was interest multiplied by tax, and then this entire expression is divided by KD. Okay. Now, if I just rearrange these terms, can I say this is simply interest by KD multiplied by T. So we are just rearranging this, or I can say it is somewhat like this. This is interest into tax rate by cost of debt. Can you tell me what is this interest divided by KD? What was interest divided by KD, guys? What was interest divided by KD? Observe value of debt, right? So this is simply the value of debt multiplied by tax rate, right? So can I say value of levered firm will be value of unlevered firm plus additional value. So value of unlevered firm plus the additional value. So simply this is going to be value of unlevered firm plus what will be the additional value? Additional value will be simply the additional value is going to be what? Value of debt multiplied by tax rate. This is simply value of levered firm will be calculated as what? Value of unlevered firm plus the additional value which you have due to the tax saving, and that is your value of debt into the tax rate. Are we clear? So this is the MM model with the taxes approach. Now in this MM model with the taxes approach, MM model with the taxes, will I call it as a theory of relevance or theory of irrelevance? Of course, it will be theory of irrelevance because now due to capital structure, the value is changing.
Sir, one small doubt. Sir, can we write value of levered firm is equal to like value of debt including taxes plus value of equity?
No. Because value of a levered firm will differ according to its equity also. Because we are not considering the equity and debt separately part over here.
We are taking it on the basis of cash flows.
Yes, overall cash flows that a firm is receiving. Yes.
Okay, sir.
Now, in this value of levered firm, how much will be the value of equity? How much will be the value of debt? That you need to look at. That needs to be further discussed.
Okay, sir.
But we are just looking at overall factor because we are keeping our base on what? The operating income approach. So under operating income approach, the value of both firms were remaining same because the EBIT was well same, your overall cost of capital was remaining same. But now due to the additional tax saving, you have an additional cash flow basically coming to you as compared to the levered firm. So as compared to the unlevered firm will have a greater degree of cash flow. And due to that, you will find that value of a levered firm is going to be additional, will be something additional to the unlevered, and that something additional is nothing but value of debt into the tax rate.
Okay, sir. Thank you, sir.
Okay. Okay, so this is what we have covered. So we are done like net income approach. We're done with net operating income approach. We're done with MM model with taxes and also the traditional model. Now only one model is left out, which is Modigliani and Miller arbitrage approach. That we will definitely take it up with the help of certain example and certain questions. Now let's just take a break because post break we'll do some questions on these models, and then we'll at the end of our session we'll take up questions on Modigliani and Miller arbitrage approach. Okay, let's take a break, guys. A break of 10 minutes. Okay. So now let's do few questions, one or two questions on this, and then possibly we'll go for the arbitrage concept. So till now, what have we really done? Nothing great. We have just covered, this formula, which is value of firm, value of equity, value of debt. Apart from that, the net income approach, the net operating income approach, then the traditional approach, and finally we had the MM model with the taxes, which was value of levered is value of unlevered plus the value of debt into tax rate. Now, let me just take up the next set of, let's look at this question list. First question, everyone. Let's do a few questions here. Lakshmi Limited is expecting annual earnings before payment of interest and tax of 2 lakhs. So this is essentially the EBIT number. Okay, so we have the EBIT. This is question number 1. EBIT of 2 lakhs. EBIT of 2 lakhs. From that, we are going to reduce the interest. These questions are already uploaded. You can find it in the assignment section. So EBIT is 2 lakh. Amount of interest. Let me just copy this question for the time being. Over there. Yeah. So EBIT is 2 lakh. Company is in capital structure. Company in its capital structure has 8 lakhs in 10% debentures. So we can say less the amount of interest. So the interest will be, it's in the capital structure has 8 lakhs in 10% debentures. So interest will be 8 lakhs multiplied by 10%, which is 8,000. So we get a profit before tax as 1,20,000. It's 8 lakh into 10%, which is 80,000. We get the PBT as this. The cost of equity or capitalization is given to us. K is 12.5%. You're required to calculate the value of the firm using net income approach. Now, value of the firm will be value of equity plus value of debt, we know. We have the cost of equity number. Now, since there is no tax, we can also say that our PAT and PBT are one and the same. How do we get the value of equity, everyone? What formula will I apply for value of equity? Yeah. What formula are we going to apply for value of equity? Can I say PAT upon K? So PAT is basically 1,20,000 divided by 12.5%. So this will be 1,20,000 divided by 12.5%. That is 9,60,000. Correct? We have the information about value of debt. So value of debt is given to us as 8 lakh. So what will be value of the firm? Value of the firm will be just total of value of equity and value of debt. Right? So this is value of equity plus value of debt. This is equal to 17,60,000, right? So required value of the firm, that is done. Also compute the overall cost of capital. How do you compute the overall cost of capital? KO. So KO will be equal to, can I say, we already know this formula, that value of firm is EBIT upon KO. So I can rearrange this, right? So rearrange this and you can simply say KO is EBIT upon value of the firm. So EBIT is 2 lakh and then you divide it by 17,60,000. So that gives us 2 lakh divided by 17,60,000. Can I say value, the overall cost of capital is 11.36. We can also get this by taking the weighted average also. Right? So let's say we can take down the equity, debt, and value is equity value is 9,60,000 and we have the debt value as 8 lakh. Of course, we can take the weights. Weights will be like value divided by the total of both, which is this, and then 1 minus this is going to be the second one weightage. How do we get the weighted average? For that, we need to look at the cost. So cost of debt is, of course, 10%, and so cost of equity is 12.5%, and cost of debt is 10%. So you can simply say weights into cost. So weights multiplied by cost. Then you take a sum of this entire portion, and you can see the number or the percentage is same as what we got using the other method also. So you can use either of it. Okay, you can use either of these two methods. You can take the weighted average number, or you can also work around with this KO equal to EBIT upon value of the firm. Okay, fine. Sure, great. Now, let us take let's take this. We've completed like first question. Now, the question of EBIT EPS. No, this is also uploaded. I have uploaded this. It's not available. I'll just check. Wait a moment. Let me just see. 1 second. Let me just look at the total. Upload. It is there. It's there. It's there. You can see under the assignment section. Check under the assignment section, you'll find it. Whenever tax rate is not given, of course, we will take the PBT is equal to PAT. Profit before tax is equal to profit after tax. True. Now, let us say, let's take this question number 4, guys. Question number 4. How question will change if tax rate is given? We'll do such questions. Wait. Ganesh Limited is expecting an EBIT of 3 lakh. The company presently raised its entire fund requirement of 20 lakhs by issue of equity at a capitalization rate of 16%. The firm is now contemplating to redeem a part of capital by introducing debt financing. The firm has two options to raise debt to the extent of 30% or 50% of total funds. It is expected that for debt financing up to 30%, rate of interest will be 10% and equity capitalization expected to be 17%. However, if the firm opts for 50% debt, interest rate will be 12% and equity capitalization will be 20%. You are required to compute the value of its firm and overall cost of capital under different options. Okay, so here we have the amount of EBIT to be 3 lakh. The amount of EBIT is 3 lakh. Company presently raised its entire fund requirement of 20 lakhs by way of equity capitalization. The current capitalization is 16%. So KE is given to us to be equal to 16%. Now, of course, since we don't have any interest in this case, you can get the profit before tax as 3 lakh minus this, and this PBT itself is our profit after tax. So since K is 16%, current value of the equity, can I say it will be 3 lakh divided by 16%. So this is like 3 lakh divided by 16%, which is 18 lakh 75,000. Okay. So PBT or PAT, we have like value of equity to be 18 lakh 75,000. So that's the value of equity which we got right now. Now we are looking to redeem a part of our capital by introducing debt financing. So debt financing means we need to look at the value of debt, right? And that debt, we have got two options. Either we can get 30% of the total funds or 50% of total funds as the debt. So let's take two options. Option 1 or option 2. Option 1 or option 2, we can say amount of debt. In the first case, the amount of debt will be like 30% or 50% of the total funds. So first case, it is going to be 30% of 18 lakh 75,000, or the second option is to take 50% of the total funds that you have. So this will be the amount of debt you are taking. Now with this amount of debt, we can expect the same EBIT of 3 lakh. Now, of course, we need to reduce the interest. Interest will be the debt multiplied by what is the rate of interest in case the company goes for 30% funding, then the rate of interest will be 10%. So we can say, so this is like the rate of interest in the first option is 10% and rate of interest in the second option is 12%. So interest will be simply the debt multiplied by the rate of interest. And then we get the profit before tax, which is 3 lakh minus 56,250. Right. So this is what we're getting as a profit before tax. Now, since obviously there is no tax applicability, so PBT and PAT both are one and the same. Profit before tax and profit after tax will remain same. Now here there is a change with regards to KE also, overall cost of capital. The overall cost of capital is earlier 17 and in the new case it is 20. So K is 17% and 20%. So what will be the value of equity? Value of equity is PAT or PBT divided by the cost of equity. So this is the value of equity in both cases. We know the value of the firm as 5,62,500 and 9,37. Right? So what will be, we know the value of debt, guys. Value of firm will be just addition of both, which is value of equity and value of debt. This is value of equity plus value of debt. We find that out of these two options, which option is actually giving me a greater value? Because the question says required to compute the value of the firm and its overall cost of capital. So overall cost of capital is basically KO. We know KO will be computed as what? EBIT upon the value of the firm. Right? So EBIT upon the value of the firm. This is what we are getting. Now, out of these two options, which option should the company actually take up? Which option should the company look for? Should the company go for a value of a firm with 19,96,000 or with a value of 18,75,000? Of course, option one, because that leads to greater value of the firm as a whole. Got it? So 19,96,324 is the total value of the firm that we have. So that is what it is. So that's done. Yes. Now, let us take next question. Yeah, question number 7. Let's take up this question number 7 for discussion. So we begin with 5th. Now let's do this question 7. RES Limited is an all equity financed company with a market value of 25 lakhs and cost of equity is 21%. The company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. Rate of tax may be taken as 30%. After the capital restructuring and applying the MM model with taxes, you are required to calculate market value of RES Limited, cost of equity, weighted average cost of capital, and then we have to compute on it, comment on it. Okay, so it is like the same company, but it is like being a geared and being a ungeared. So we can say first as without debt, one calculation will be there, and then with debt. So if you start with the EBIT thing, do you think EBIT is going to be different for both the companies? I mean, with debt and without debt, is it going to be different? No, EBIT is going to be remaining same. So right now, it's an all equity finance company with a market value of 25 lakh and a cost of equity of 21%. Company wants to buy back this. Now we don't know what is the EBIT. Of course, I can say the interest is 0. We don't know what is a PBT, and from that obviously we'll be deducting the tax also and the PAT. So, but cost of equity and the market value is given to us. So we know the cost of equity, and we know the value of equity can be calculated as PAT divided by K. So that's simply PAT divided by K. We know the value of equity is, all equity finance company with a market value of 25 lakh. Value of debt is nil over here, and currently value of the firm is simply the addition of these two. Now, if the value of the firm is 25 lakh and your cost of equity is 21%, can we get the PAT? Can we get the PAT? Profit after tax. Buyback is income or debt. Buyback is you are going to buy the equity shares back from your equity shareholders. So you will pay some money to your equity shareholders, get their shares back, destroy it. Right? So you will take loan and then redeem the equity shares or buy back the equity shares of the company. Yeah. So what will be the PAT? Can I say here the PAT calculation is pretty decent, where we say that PAT can be I can compute this as possibly 25 lakh. 25 lakhs multiplied by 21%. So this is like 25 lakh into 21%, which is 5,25,000 is a PAT, right? Now we can do the reverse calculation, guys. What's the tax rate? Tax rate is 30%. So by doing the reverse calculation, can you tell me what is the tax and what is the the PBT? So 5,25,000 is a PAT. By doing the reverse calculation, can you tell me what's the profit before tax? Okay, so we do the simple reverse calculation, which is 5.25 lakhs divided by 0.7 and multiplied by 0.3. So by doing that reverse calculation, so this divided by 0.7 into 0.3. This is 2,25,000. And PBT will be, of course, the addition of these two items, which is 7,50,000. Correct, guys? PBT is 7,50,000. Reverse calculation, can I say PBT is 7,50,000 on that 25%, which is on that, sorry, 30% is the tax that you pay, which is 2,25,000, and then the PAT. Now we don't have any interest. So what will be the EBIT? EBIT will be, can I say, interest plus PBT, that's 7,50,000 itself. Now the same EBIT will be carried forward to the situation where the company has got debt. If the company is having some amount of debt, okay, if the company is having some amount of debt, it will be obviously retaining the same EBIT position, but there will be interest and other part of income statement will change. The rest part of the income statement is going to change because of the debt in the company, right? So what is the debt that the company is really looking for? The company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. So value of debt is 5 lakh. So we want to buy back 5 lakh of our equity shares from the market, right? By taking debt of 5 lakh from the market. So if you take 5 lakh debt, what is the interest that we are going to have? Can I say it's going to be 5 lakh multiplied by 15% because the rate of debt is 15%. So what will be the amount of interest that we need to pay once you become a company with debt? Once you become a company with debt, what is the amount of interest that I'll have to pay? Can I say 5 lakh multiplied by 15%, which is 75,000. Right? So we get a PBT of 6,75,000. And then we subtract the tax, PBT multiplied by 30%. And then PAT is like 4,72,500. Right? Now we don't know the amount of KE given in the question, and neither the question has mentioned that we have to take net income approach. But then how do we go about calculating it now? The cost of equity. Remember, this is to be used MM model with taxes. So if it is MM model with taxes, we'll have to first calculate the value of the firm. Why 0.3? 30% is the tax rate, right? Tax rate is 30%. I'm not getting what 0.3 you are saying. Anyways. Yeah, so since this is MM model with taxes, reverse calculation of tax. Your PBT is 100, tax is 30, this is 70. So you can simply do the cross multiplication, right? You can simply say it is 5,25,000 divided by 30 multiplied by 70. Sorry, this is going to be reverse calculation will be 5,25,000 multiplied by 30 divided by 70. Just the cross multiplication. Okay. So now, so coming to this MM model. So MM model, the conclusion was the value of a levered firm was equal to value of unlevered plus debt into tax rate. This is what we have already learned, right? So it will be essentially 25 lakh plus 5 lakh multiplied by 5 lakh is the value of debt multiplied by tax rate, which is 0.3. So I can say it is 25 lakh plus 5 lakh multiplied by 0.3, which is 26 lakh 50,000. So value of the firm is 26 lakh 50,000. When we do the reverse calculation, since the value of the overall firm is 26 lakh 50,000, value of debt is 5 lakh. Now the value of equity will be 26 lakh 50,000 minus 5 lakh. This is 21 lakh 50. How do we get the K? K can be computed as PAT divided by value of equity. So this is simply PAT divided by the value of equity. And we observe that the cost of equity rises with the debt being taken by the company. Okay. So that's how we typically solve it. So we did the first reverse calculation over here, right? Buyback of equity share and calculated as 25 lakhs. Get you? Yes.
Sir. Good evening, sir.
Good evening.
Sir, with the debt we have buyback the share of 5 lakhs, sir.
Yeah.
Then we calculated 25 lakhs as the value of equity, sir.
5 lakh is the value of debt because we are borrowing 5 lakh and repaying that to the equity shareholders to get their shares back to us.
Sir, buyback of security does not decrease the value of equity, sir.
It does decrease the value of equity. You can see it from 25 lakh, it reduced to 21 lakh 50,000. Value of equity has reduced, but it's not the exact same amount what you are paying them. Once you do undertake the buyback, the value of the share is going to rise because now the shareholders are like, earlier we were getting like 21% return. Now, due to the debt, because the company has got a lower cost of debt, right? So at a lower cost, the company is going to earn, of course, higher net profit margin, and therefore our value of the shares will not be exactly falling by 5 lakh.
So the value of firm is equal to 25 lakhs plus 5 lakhs into 0.3, sir. The value of equity will be 25 lakhs. I am asking that, sir.
No, value of earlier it was 25 lakh. After buyback, it will become 21 lakh 50. After buyback, value of equity will become 21 lakh 50 because overall value of the firm will be 26 lakh 50. Because it's a levered firm. So levered firm will always have the advantage of that tax saving. So that tax saving is adding as an additional 1,50,000 value, right? And the net increase in the value of equity will be a negative, like it will get reduced by only 3.5 lakhs.
I did not get that.
I mean, what's your exactly the query? You were saying that value of equity is not falling, which I said value of equity is reducing.
50,000 is 1,50,000 is more than the value.
Yeah, because that 1,50,000 is the tax saving due to the interest, which we have discussed in the MM model. There is this, right? Value of levered form will be unlevered plus value of debt into tax. So this will be the extra value which you will be having in the levered form as compared to the unlevered form.
Okay, sir.
That 1,50,000 is adding to the total value. Okay.
Okay, sir.
Okay.
सर
Yeah, बोलो.
सर हम इसमें मतलब फॉर्मूले के साथ ही कर सकते हैं, ये मतलब पूरा करने की जरूरत नहीं है ना, जैसे EBIT माइनस इंटरेस्ट, ये मतलब रिवर्स में हम गए हैं और फिर हमने पूरा किया है, डायरेक्ट फॉर्मूले से कर सकते हैं सर?
Yes, you can. कर सकते.
सर आपने जो फाइल अपलोड करी है ना वहाँ पे पोर्टल पे, वो सिर्फ 4 अक्टूबर की है, ये वाले क्वेश्चंस नहीं है सर उसमें.
नहीं, असाइनमेंट वाला है ना, असाइनमेंट सेक्शन में देख.
सर दोनों सारी जगह देख लिया सर, ये वाले क्वेश्चंस नहीं है.
वाला तो है भाई, मुझे तो दिख रहा है, ये अपलोड किया है
सर अब हमारे पोर्टल में लास्ट आपका अपलोड सिर्फ 4 अक्टूबर को आया है.
अक्टूबर को ये तो है कैपिटल स्ट्रक्चर, मुझे दिख रहा है ये क्वेश्चंस. लेट मी चेक, क्योंकि यहाँ पे तो मुझे तो दिख रहा है पोर्टल पे, मैंने डाला है.
सर क्योंकि हमारे पास नहीं आया तभी पूछ रहा था मैं.
असाइनमेंट में, नोट्स में, इवनिंग सेशन.
सर क्योंकि मैं तो पोर्टल खोल कर ही बैठा था.
आई थिंक है तो सही, क्योंकि मैं तो स्क्रीन पे दिखा देता हूँ. That is there. Let me see if there is some portal. It will take time. I have uploaded it in the morning. मैं सुबह अपलोड किया था.
ठीक है सर.
देखते कल तक आ जाएगा शायद.
ओके सर.
सेम डे तो आ जाता है. यस कसक.
Sir, I have a question that the issue of equity will not help hold, मतलब कि वो.
Sorry.
सर मेरा क्वेश्चन है कि इशू ऑफ इक्विटी हम मतलब कि अगर जैसे कि हमने क्वेश्चन में 20 लाख इशू करा था, तो उसका मतलब कि उसकी वैल्यू से कोई फर्क नहीं पड़ता है ना?
25 लाख इशू करा था ना इसमें.
नहीं सर, पिछले वाले क्वेश्चन में और इसमें भी ये तो मार्केट वैल्यू रखी है ना.
हाँ, वो तो बुक वैल्यू है, हमने जो इशू किया दैट इज बुक वैल्यू.
तो सर इशू ऑफ इक्विटी से सर मतलब कि कोई वो नहीं फर्क पड़ता है ना वैल्यू का, कॉस्ट ऑफ इक्विटी का?
नहीं, दैट्स बुक वैल्यू और मार्केट वैल्यू में फर्क होता है ना.
वो सेपरेटली मतलब कैलकुलेट होती है ना.
बुक वैल्यू तो आपने जो जितने का शेयर इशू किया है, जो आपके सिक्योरिटीज प्रीमियम और इक्विटी शेयर कैपिटल मिला के, बट मार्केट में तो वैल्यू अलग ही होगा ना इक्विटी शेयर्स का.
ओके सर.
डिमांड सप्लाई की वजह से होगा. ओके चलो ठीक. नाउ Yeah, now let's go for the MM arbitrage model. Now for that arbitrage model, we'll take up question. Yeah, we'll take up this question number 10, guys. See, so we have like two companies, N and M, having same earnings before interest and tax of EBIT of 20,000. So there are two companies, N and M, with the same EBIT level. So EBIT is same for both the companies, which is 20,000. So N limited and M limited. Having the same earnings before interest and tax. M limited is a levered company. So this one is a levered company, which is having a debt of, let's say, 1 lakh. And of course, N limited will be unlevered. Okay, so from this, we can actually say about the capital structure. From this, we subtract the interest. Of course, since this is an unlevered, there won't be any interest. What about M limited? In the M limited, since it is a levered company having a debt of 1 lakh at 7%, the amount of interest which will be paid by M limited, what will be the value amount of interest that will be paid by M limited? What will be the interest? $7,000, right? So PBT or the profit after tax will be remaining same, which is 20,000 and 13,000, right? So PBT or PAT will be 20,000 or 13,000. We have like cost of equity. For N limited, it is 10%, and for M limited is 11.5%. Right. Now from this, we can get the value of equity. What is the value of equity for both the companies? Tell me, guys, what will be the value of equity for both companies? So for this, it will be like 20,000 divided by 10%, and it is 1 lakh 13,043, correct? Now, what about the value of debt? There's no value of debt over here, but in this case, we have a debt of 1 lakh. Overall value of the firm is 2 lakh and 2 lakh 13,000, right? Now, out of these two companies, since we are following the MM arbitrage model, what was MM arbitrage model? The MM arbitrage was placed in theories of irrelevance. So as per this model, what should happen to the value of these two companies? What should happen to the value of these two companies? Ideally, the value of these two companies should be, can I say same? Ideally, the value of the two companies should remain same, because they are saying that MM model is saying that they are levered or unlevered in the absence of tax. Whenever there is tax, there will be difference in value. But when there is no tax, applicable, value of both the firms is going to remain same. Right? Value of both the firms should remain same. But do we see the similarity? No. The values are essentially not the same. Value of both the firms is not the same. Right? So how do we go about then, understanding the aspect of levered and unlevered and other aspects? Okay. So both the firms are not same. So there will be something called as arbitrage. Now, what is arbitrage? Have you ever heard this term called as arbitrage, guys? Heard this term? Have you heard this term called as arbitrage anytime earlier? Arbitrage? No? No? Okay. See, for example, we have two stock exchanges, National Stock Exchange and Bombay Stock Exchange, right? So National Stock Exchange and Bombay Stock Exchange. One share is priced at 230 in National Stock Exchange and it is priced 235 in Bombay Stock Exchange. So tell me, as a rational person, what will you do? As a rational person, what will you do? As a person who is looking to profit, is looking for opportunities to profit, what will you do? What will be your plan of action? Can I say we will purchase from NSE at a price of 230 and sell it in BSE at a price of 235? And by doing that, can I say you get a profit of 5 rupees? Purchase from NSE, sell in BSE, which will give us a profit of 5 rupees, correct? It means in arbitrage strategy, we are going to buy here and we are going to sell here. Why did we buy this? Because this was undervalued. And why did we sell this? Because this was overvalued. So NSE, we bought it because it was undervalued. BSE, we sold it because it was overvalued. Now, similar strategy of buying one shares and selling other shares will be undertaken by this arbitrage process. I hope arbitrage process is clear. Are we clear? What do we mean by arbitrage? Right, guys? So what do you mean by arbitrage? What do we really mean by arbitrage? Arbitrage means buying the shares in the overvalued, undervalued market and sell it in the overvalued. So whatever is undervalued, we are going to buy. Whatever is undervalued, we are going to buy, and whatever is overvalued, we are going to sell. Right? So we are going to buy the shares which are having a lesser price and sell the shares which are having a higher price. Right? This is what we mean by arbitrage. Now, out of these two companies, which one is overvalued and which one is undervalued? Out of these two companies, overall value of the companies, if you look at it, which of these two companies are having a overvaluation and undervaluation? Can I say M is overvalued and N is undervalued? So what would you like to do as an investor? As an investor of M Limited, suppose as an investor of M Limited, what would you like to do with the shares of M Limited? What will you do with the shares of M Limited? Can I say you are going to buy the shares of N by selling the shares of M? So what will be our arbitrage strategy? What will be the arbitrage strategy? Arbitrage strategy will be sell shares of M and buy shares of N. Correct? Now, why would you like to do this? Just because it is undervalued or overvalued? No, because can I say you will be looking to profit from it. You will be trying to make profit from it, correct? You would be trying to make profit from it by selling the shares of M and buying the shares of N. You would like to make some profits. So let us see, are we really able to undertake this profit path? So what is the steps? What are the steps that we have in this strategy? First step, if you're saying that you are going to buy the shares of N Limited, of course, I need to have that much money. So let's consider an investor who holds 10% stake in M Limited equity shares. So let's consider an investor who is holding 10% stake in M Limited equity shares. Let's consider an investor who is holding this 10% stake in the M Limited equity shares. Okay. Now, First step. First step is sell shares of M Limited. Now, by selling shares of M Limited and receive, how much amount is the investor going to receive by selling the shares of M Limited? What will be the amount that the investor is going to receive? The current value of the equity shares is 113043, right? That's the value of equity shares which the investor is having. We are not, because you are an investor in M Limited. You are an equity shareholder. So this is the value. On that, of course, you will be receiving 10% because you are holding 10% stake in it. This is like 1130 into 10%. So 11,304 is the value of the shares that you are going to sell. So you are receiving this 11,304. What are we going to do with this 11,304 money that we received by selling the shares of M Limited? What are we going to do? Can say we are going to take that money and invest in N Limited shares. Right? We are going to buy this 11,300. We are going to receive this 11,304, but we will buy the shares of N Limited. Correct? Okay. But wait. When you were a shareholder in M Limited, were you in a situation, or is it like you were facing some sort of risk? Were you facing some sort of risk when you were a shareholder in M Limited? Where are you in a situation where you're facing some amount of financial risk? Yes, because there was debt. For 1,13,000 equity, there was a debt of 1 lakh on the company. Correct? For a value of equity of 1,13,000, you had a risk of debt on the company. So there was actually indirect risk on your equity shares investment of 1 lakh. So now if I take this 11,304 and simply invest in N Limited shares, is the risk remaining same? The risk which you were taking earlier and the risk that you have now? Because earlier 1,13,043 or 11,304 was subject to debt of, can I say his share of debt was 10,000? Because if the overall company was having a debt of 1 lakh, if I was 10% equity shareholder, my equity shareholding investment was subject to a risk of 10,000 of debt. Correct, guys? Yes. So overall, entire company was having a debt of 1 lakh. Since I was 10% shareholder, I was subjected to a debt of 10 lakh. Now, if I just take this 11,304, and invest in the shares of N, is the equity or is the risk remaining the same when I was invested in the levered form and when I'm invested in the unlevered form? No, the risk is not same. So now, how do I match the risk? What will I do in the second step is borrow 10,000 to match the risk. So we are going to borrow 10,000 to match the risk. Okay. So to match the risk, we are going to borrow. So how much are we going to borrow? 10,000. So what is the total funds available with investor now? Total funds available with investor. How much is the investor having in total? 11,304 plus 10,000 debt. So essentially it is having a total of 21,304, which is the same situation as was earlier. So when you were an investor in this company, you are entitled to assets of 10%, which is 21,304, out of which your investment was 1,13,000 and 10,000 was a debt taken by the company. Now, what will I do with this amount of 21,304? What will I do with this 21,304? Tell me. What am I going to do with this 21,304? We are going to buy the shares, right? So we will buy shares of N Limited. We're going to buy the shares of N Limited for rupees 21,304. Okay, this 21,304 is equal to what proportion stake in the shares in the company? What proportion stake in the company N Limited? Can I sit with 21,304 divided by 2 lakh, which is 10.65% stake. So 10.65% stake in N Limited. Correct? So we are getting 10.65% stake in N Limited. Now, the step number 4. Let us do the calculation. So we are going to buy shares of N Limited, basically taking 10.65% stake. Now, what's the result? We want to know the earnings of investor under both situations. When you were invested in M Limited and when you are now invested in N Limited. So it is like, what was the share in PAT that we had? In case of M Limited, share in PAT was 10%, and now the share in PAT will be, of course, 10.65%. So share in PAT, share in profit after tax, in terms of rupees, will be what? 10% of earlier PAT of 20,000, right? Because earlier PAT of 13,000. So you were having 10% stake in the PAT of 13,000, which is 1,300. Now you are going to have 10.65% of 20,000. So of course my PAT share is higher, but this entire amount 2130.43 is not something which I'm going to take home, because I need to also pay the interest on loan. In this case, when I was earlier investor in M, I was not supposed to pay any interest. Because the interest portion was taken care by the company. But when I'm invested in N, I am going to pay some amount of interest, and that interest is simply the 10,000 loan that we took at a rate of same rate as the company was taking. So the earlier case, when the rate of interest is mentioned to be 7%. So essentially we are like paying 700 as interest. So what is the net profit? So earlier my income was 1,300, and when I shifted to the new company, which is N Limited, my income has increased to 1,430. So as a rational investor, would you like to stay yourself? Would you like to keep yourself invested in M Limited, or would you like to divert your investment to N Limited to get a profit of additional maybe 130? Of course, we are going to divert our investment from M to N Limited so that we can match the risk and also get a higher profit. Okay, so we have to borrow the amount equal to proportion of debt always, yes, because then only we are going to match the risk, right? So earlier I had a certain amount of risk, and now also I'll have certain amount of risk. So that risk is matching, and therefore we do it in this way. Okay, so investors are going to shift from M Limited to N Limited. So not only this investor, any rational investor will simply sell the shares of M Limited and is going to shift towards N Limited. So if this is happening, what will happen to the share price of M Limited, guys? If investors are going to shift from levered company to unlevered company, what will happen to the share prices? What will happen to the share prices of M? M Limited share prices will go down. What will happen to the share prices of N? What will happen to the share prices of N Limited? Share prices of N Limited will go up. So it will, like, one company share price will increase, the other company share price will decrease. So this overvaluation, undervaluation concept will go away and they will balance each other, and the value of the firms will remain same irrespective of whatever be the capital structure, because then once the value of both companies are equal, there won't be any arbitrage opportunity. Okay, so that is this MM model of arbitrage. Yeah, guys. So with that, we are through this entire topic of capital structure. We don't have a class tomorrow, but yes, we'll be meeting on Saturday. Not on Saturday, next week. So next week, we'll take up the last topic, which is the leverage. Okay, so it's always the time gap, right? It's not the time gap, because arbitrage has to be implemented in one time itself. Arbitrage in share market is eliminated by SEBI. It's not eliminated by SEBI. You can definitely buy in one area and sell in another area, but then there will be a transaction cost. Yeah, there will be a transaction cost. So, right. So that transaction cost is something, which will not make it possible for you to undertake arbitrage. For intersection point, NLS Ravani, we have discussed it way back in the previous class itself. Okay. One more arbitrage problem. We'll have it. One more arbitrage problem. Don't worry. We have scheduled some revision sessions for capital structure also. So there we will take up those aspects or those questions. Okay, we'll have more questions of this. So for all topics, we are having the revision sessions. There we are taking more and more questions for your practice. Okay.
गुड इवनिंग सर.
क्या भावना?
सर मुझे स्टेप 1 से समझ नहीं आया.
स्टेप 1 से समझ नहीं आया?
नहीं सर.
क्या समझ नहीं आया?
सर इसमें ये 113043 मल्टीप्लाई 10% क्यों किया है?
ये अज्यूम किया है. We assume that investor is holding 10% stake. पूरा कंपनी तो मेरा नहीं हो सकता है, तो मैं इन्वेस्टर हूं, मैं अज्यूम कर रहा हूं चलो मेरे पास इस कंपनी के 10% शेयर्स हैं. तो अगर 10% शेयर है तो बेचूंगा तो कितना मिलेगा मुझे? पूरे कंपनी का वैल्यू है, पूरे कंपनी का इक्विटी शेयर का वैल्यू है 1,13,000, तो उसका 10%, so 11,304 मिलेगा मुझे.
ओके सर.
है ना? और फिर उसको मैं
सर
लोन
फिर ये
के साथ 10,000 हमने बोरो किया, क्योंकि पहले जब मैं एम में इन्वेस्टर था तब यहाँ पे कंपनी के ऊपर 1 लाख का लोन था. सो हमने क्या किया कि अभी तो कंपनी के ऊपर लोन है नहीं, क्योंकि हमने तो अपने पैसे निकाल लिए, तो रिस्क अगर मैच करना है तो मैं बोलूंगा मैं खुद लोन ले लेता हूँ, सेम रिस्क मैच करेंगे और फिर ये कंबाइंड अमाउंट को मैं एन के शेयर्स में इन्वेस्ट करूंगा.
सर मुझे मतलब ये 10,000 ही क्यों लिया है सर?
10% है ना, तो जब आप व्हेन यू आर शेयर होल्डर इन द कंपनी, आपके पास 10% स्टेक था, तो लोन का भी 10% लायबिलिटी आपके ऊपर आएगा, राइट? 1 लाख का 10%. If you are owning 10% of equity shares, liability of 10% will be also on you. So इसीलिए 10,000 का लोन लिया, राइट? बिकॉज दूसरे कंपनी में टोटल वैल्यू 2,13,000 था, जिसमें मैंने सिर्फ 10% इक्विटी शेयर्स लगाए थे. तो ऑब्वियसली मेरे ऊपर इनडायरेक्ट एक लोन था ना जो कंपनी के ऊपर था, अब वो इनडायरेक्ट लोन को मैंने यहाँ पे डायरेक्ट लोन में कन्वर्ट कर दिया, क्योंकि नहीं तो रिस्क मैच नहीं होगा. क्योंकि 11,300 जो एम लिमिटेड में इन्वेस्टेड है लीवर्ड में, सेम अमाउंट इधर इन्वेस्ट करूंगा तो रिस्क मैच नहीं होगा, बिकॉज हियर देयर इज अ लोन, हियर देयर इज नो लोन. सो हाउ डू आई मैच द रिस्क? उसके लिए लोन लेना पड़ेगा, एंड देन टोटल अमाउंट हमने अनलीवर्ड में इन्वेस्ट किया।
ओके
ओके,
यस सर। सर फिर ये एम लिमिटेड के बेसिस पे ये मतलब एन लिमिटेड के शेयर्स कैसे निकाले हैं?
ये तो 21,304 आपके पास आ गए लोन लेने के बाद।
यस सर।
हाँ, तो 21,304 रुपए हमने इन्वेस्ट कर लिया इस कंपनी में, अनलीवर्ड में।
अच्छा
तो पूरे कंपनी का वैल्यू था 2 लाख, उसमें से हमने लिया 21,304 रुपए के शेयर। तो कितना परसेंट पावर आ गया अपने पास उस कंपनी में? 10.65, राइट?
ओके यस सर।
और मैं प्रॉफिट में भी 10.65% दूंगा अभी, है ना? और
Yes,
देखते हैं
sir,
कि
आ
सर जब
गया।
प्रॉफिट पे करने के बाद हमें यहाँ पे प्रॉफिट फायदा हो रहा है, तो हम लोग एम से एन में शिफ्ट हो जाएंगे।
ओके सर।
ओके,
यस सर।
सर मेरे को एक छोटा सा डाउट था सर, ट्रेड ऑफ इसको तो नहीं कहेंगे ना?
ट्रेड ऑफ नहीं होता है
सर तो ट्रेड ऑफ क्या हुआ फिर, जब इक्विटी और डेट का वैल्यू हम
डेट के बीच में तुझे चूज करना होता है कि इक्विटी से फंड उठाओ कि डेट से फंड उठाओ।
तो उनका कॉस्ट हम देखते हैं, जिसका भी
हाँ,
कॉस्ट कम
कॉस्ट
होगा,
उसका नेट इफेक्ट। हाँ,
तो जिसका कॉस्ट कम होगा
पिछले
वो।
चैप्टर में कैपिटल स्ट्रक्चर करते थे ना हम,
यस सर।
तो ये 3 ऑप्शंस होते थे, तो उसमें एक में इक्विटी होता था, एक में डेट होता था। तो डेट की वजह से आपका कॉस्ट ऑफ कैपिटल कम होगा,
हाँ जी सर।
है ना? तो वहां पे डिसीजन जब ले रहे थे तो वो होता है,
वो ट्रेड ऑफ होगा, ठीक है सर। सर एक छोटा सा डाउट है सर, मैंने डू पॉइंट आपका देख लिया था, आपने उसमें ना शेयर होल्डर फंड लिखा था, तो सर अगर प्रेफरेंस शेयर आएगा तो वो भी इंक्लूड होगा ना शेयर होल्डर फंड में?
प्रेफरेंस शेयर आएगा तो शेयर होल्डर्स फंड में नहीं होगा बेटा, क्योंकि वो फिर डेट के तरीके का ही होता है ना, उनको तुझे फिक्स रिटर्न देना होता है।
लेकिन सर फिर आपने उसमें शेयर होल्डर फंड ही लिया था, आपने इक्विटी नहीं लिया।
हाँ, मतलब यू टेक द इक्विटी, वहां पे इक्विटी उसका मतलब होता है, बिकॉज प्रेफरेंस शेयर्स पे तो आपको फिक्स्ड इंटरेस्ट देना है, राइट? तो वो एक सॉर्ट ऑफ कैपिटल गियरिंग वाला पार्ट आ जाता है।
तो फिर वो सर लेवरेज के साथ ऐड होगा?
हाँ हाँ, इस लेवरेज का पार्ट होगा।
ठीक है सर। एंड सर कैन यू प्लीज अपलोड वो रेशियोज वाले सॉल्यूशंस?
हाँ, जस्ट मैं करता हूँ। रेशियो, कॉस्ट ऑफ कैपिटल और इसके रेशियोज वाले तो क्वेश्चंस हो गए हैं, तो उसके सारे सॉल्यूशंस मैं अपलोड करता हूँ।
ठीक है, थैंक यू सर।
सर आपने जो 10% अज्यूम की है वो हम कोई भी परसेंट अज्यूम कर सकते हैं?
हाँ, कोई भी कर सकते हैं, कोई भी 5%, 20% कोई भी ले सकते हैं। 10% इजी कैलकुलेट करने होता है, इसलिए 10% दिया था।
ओके सर।
ओके, चलो then let's just stop here guys, see you in the next week, bye bye।